Hello dear students. In the previous video we have discussed with the general ways of managing the risk. Those are all 7 points per there. Okay. In this video we'll move further concept, that is types of business risk. Okay. These types of business risk means nothing but which kind of a risks will arise in derivatives market. Okay. Basically for your syllabi only the 4 risks were there, but I'll do the 16 types of risks which may arise in derivatives market. Okay. So in this video 8 and in another video 8 I'll make. Okay. The concept of risk in derivatives market can be based on the risks the investors carries in the stock market. Businesses and investors use derivatives to increase or decrease exposure to 4 common types of risk. Basically, there are 4 types of risks which will arise. But along with that, there are many more types of risks which may arise in derivatives market. So that is why I will do all the types of risks which may arise in derivatives market, but in your syllabus only the 4 type of risks were there. Okay. Commodity risk, stock market risk, interest rate risk and credit risk. Okay. So one by one we'll go further. That is, the first type of a risk is commodity risk. Okay, commodity risk means it will arise in commodity type derivatives market. That is, which kind of a commodity if I going to select, then what type of a risk may arise, and how can I mitigate that particular risk. Okay, a business that must buy a commodity in the future is exposed to the risk of a rapid increase in the future price of that commodity. A futures contract, a common derivative, can be used to reduce risk exposure to volatile commodity prices, because the commodity prices will vary from one day to another day, right? So if I am going to take any moong dal, okay, that is a one underlying asset. Okay, that price on the first day, that is on this day, it may be 50 rupees. On the very next day it may go to 55 rupees, or it may come down to 49 rupees. Okay, that is the risk. So how that particular risk can be mitigated means by selecting the proper commodity which will be going to rise in the future. We need to select that type of a commodity. Okay, so if you take the commodity of petroleum or kerosene product, any kind of a petroleum products, those are all not going to decline. Those will be in a higher only. Okay, and next is the software type of a company. Sorry, that will not come. Only the petroleum products or any daily consumable what we require for to prepare with the cooking. So those type of commodities which will be always rise. Okay, in the first chapter itself I have told you, that is the commodities list I have given, right? In that commodities list, which is have the higher price range, if they are going to make an investment, then the risk will, whatever will be going to arise, that may not be. Okay, this is about the commodity risk. And the second risk is stock market risk. Okay, stock equity options, another common derivative, can be used to increase or decrease exposure to the risk of rapidly fluctuating stock market prices. That is, the stock market prices are very volatile in nature. Okay, there are 2 types of option contracts, this is calls and puts. The owner of a call option owns the right but not the obligation to buy an asset at a specified price, known as option strike price, by a specific date in the future. Right. So, stock market risk means it is purely relating to the prices, stock market prices. Okay. if there is a variation in the stock market prices, then how it can be curbed or controlled means it is very simple. uh, Whoever going to make an investment more, if we choose that kind of a securities, we cannot possible to, or we can't expect those prices will come down. Okay, that is why we need to go with the high priced securities if the investor want more profit, or otherwise they can go with a moderate priced contracts as well. Okay, like that there are many ways we can reduce the risk of stock market prices. Okay, the third is the interest rate risk. Okay, that is interest rate risk is common in case of derivatives market and the bond market. Okay, companies issue bonds to investors that pay either fixed or floating rates of interest. If a company issues fixed rate debt, the risk is that interest rate fall and the company is stuck paying an above market fixed interest rate on their debt. That is the debt whatever issued by the companies. Okay, for that they need to pay, that is an investor need to pay the interest, right? So that interest if they are not going to pay, then it is a biggest problem for the companies, not the public parties. It is a greatest problem for the companies, right? And interest rate risk is the risk to earnings or capital arising from movements in interest rates. The magnitude of interest rate risk faced by derivatives from an adverse change in interest rates depends on the sensitivity of the derivative to changes in interest rates as well as absolute change in interest rates. While writing your assignments, I think you may observe that there will be an interest rate column as well. Okay, on every underlying asset there will be a certain fixed type of interest rate will be going to levied. Okay, if that particular interest rate is not at that mark, okay, then it will be problem for the investor. Okay, and next is final organizations are exposed to interest rate risk through their structural balance sheet propositions. And if a company issues, that is LIBOR and MIBOR rate will come, right? I have already told you in swaps this LIBOR rate and MIBOR rate will come, right? That interest rate, if there is any fluctuations, then it is also one type of risk. And that risk how it will be mitigated means by maintaining the proper interest rate for the companies. If the interest rate being provided to the companies in a stipulated time, then there will be no problem for the investors. They can continue the contract. Okay. Next type of risk is credit risk. This credit risk will be going to arise where the investor will take the credit from the parties or the financial institutions. Okay. Derivatives are subject to credit risk or the risk to earnings or capital due to obligator's failure to meet the terms of a contract. Okay, I have taken the loan, but I have not repaid that. Okay, then from whom I have taken the loan, they will undertake all my contracts. Okay, derivatives are exposed to pre-settlement credit risk or loss due to failure to pay on a contract during the life of a transaction by the counterparty. Okay, means pre-settlement credit risk means before the maturity date, if they want to segregate that, then it is also one type of risk. Okay, and next is derivatives are also subject to settlement risk. At the time of settlement also there will be a this credit risk will arise, because if I have taken the loan, then I have not paid that, but I am enjoying my profit, right? At that situation the creditor will come and they want the money. Okay, settlement risk generally exists for 1 to 2 days from the time an outgoing payment instruction can no longer be cancelled unilaterally until the time the final incoming payment is received and reconciled. Okay, this is all. Just I'll give the glimpse of this credit risk. Credit risk means nothing but I have taken the loan from anyone. Okay, but I have not repaid that, but I am enjoying profit. Okay, at that situation the creditor will come, give our money, and you enjoy your profit. Okay, this is the way in which this credit risk will be going to settled out. Okay, and the next risk is counterparty risk. That is this contracts always which is going to lies between the two parties, right? That two parties are named as the counterparties. Okay, if there is no any mutual understanding between the parties whoever entered into the contract, then there will be a issues or conflicts are very common. Okay, if there is no mutual understandings, then this counterparty risk will be going to arises at that time. Okay, counterparty risk or counterparty credit risk arises if one of the parties involved in derivatives trade, such as the buyer, seller or dealer, defaults on the contract. This risk is higher in over the counter, which are much less regulated than ordinary trading exchanges. Okay, so this counterparty risk means I have already told you, if there is no mutual understanding, then this risk will be going to arises, right? Why in OTC markets this risk is higher means there is all the contracts are customizable. Okay, so there will be no any hard and fast rule that you need to go like this or you need to go like this. So that's why they are the supreme there in the OTC market. Okay, so that's why this risk is most common in OTC, but in exchange traded or in ordinary trading exchanges this will not arise as much. Okay, but it is more in OTC. But how this risk can be reduced means through the help of the mutual understanding only. Proper mutual understanding it need to be there. Okay, next is liquidity risk. Liquidity means whatever the cash is in the form of digital, it need to be liquidated to the cash, right? Or it need to be converted into the digital hard cash only. Okay, that is liquidity risk applies to investors who plan to close out a derivative trade prior to maturity. This liquidity risk will arise if the investor wants to close their contract before the maturity, because if maturity period completes, then the liquidation is very easy. Okay, if the liquidation if the maturity period is not over, if they want to complete or if they want to close the contract, then this risk will be going to arises. Okay, there are two type of liquidity risks, that is market liquidity risk and funding liquidity risk. So market liquidity risk is that the risk that an organization may not be able to exit or offset positions easily at a reasonable price at or near the previous market price because of inadequate market depth or because of disruptions in the market. That is, market liquidity risk means market becomes weak in one point of a movement. Okay, at that situation, if the investor wants to end up the contract, then it is not possible. Okay, they need to go till the market completes or till the maturity date need to come. At that situation, the liquidation risk will not arise because the period is over, then the contract going to complete, then there will be no problem. Okay, and next is funding liquidity risk. Funding liquidity risk is a possibility that the organization may be unable to meet funding requirement at a reasonable cost. This funding liquidity risk means this is similar to the credit risk. Okay, in the credit risk, there will be a financial institutions will give the loan, but here this funding liquidity risk will be going to provided by the dealers or the stockbrokers who are there in the exchange traded or in OTC market. Okay, if the funding whatever we will get in order to make an investment, if it is not properly repaid, then this risk will arises. So that's why the investor need to set off all the risk within a stipulated time. Okay, and the next risk is interconnection risk. Interconnection risk refers to how the interconnections between various derivative instruments and dealers might affect an investor's particular derivative trade. Okay, means interconnection means nothing but there will be a buyer, there will be a seller, and dealers who will be going to help to them. Okay, there are many middleman persons will come, right? If there is no any mutual understandings, okay, at that situation this interconnection risk will arises. If this risk will arises, the entire contract will become as one of the stringent one. Okay, some analysts express concern over the possibility that problems with just one party in the derivative market, such as a major bank that acts as a dealer, might lead to a chain reaction or snowball effect that threatens the stability of financial markets overall. That is, if once the bad opinion generated in one person, he will be going to tell that to 8 to 10 members. This is a psychological fact. Okay, like that, the negative spreading is very much faster than the positive one. Okay, so that is why always there should be a harmonious relationship between everyone. Okay, then this type of a risk will not arise, and the trading function will also be very smoother. Okay, and the next risk is the bottom line risk. Bottom line risk means, like any other investment, derivatives risk levels are calculated through a mixture of evaluation of the market risk that all investments are susceptible to counterparty risk if a party involved in the trade defaults, liquidity risk of the actual companies being invested in, and interconnection risk between various derivatives. Whether used for risk management or to grow an investment, they are one of the most popular instruments in financial markets today. That is, bottom line risk means nothing but this is a combination of the liquidity and interconnection risk. That is, liquidity risk means before the maturity period date, if they want to end up with a contract, then that is also very difficult to do that. Okay, and the interconnection risk means that kind of a risk means the closing of a contract will comes into their mind because of the misunderstandings whatever going to arises between them, right? So if those type of risks are combined, then we will call that particular risk as the bottom line risk. ಓಕೆ, ಈಗ ಏನಂತ ಹೇಳಿದರೆ, ಲಿಕ್ವಿಡಿಟಿ ರಿಸ್ಕ್ ಅಂತ ಹೇಳಿದ್ರೆ ಮೆಚುರಿಟಿ ಪೀರಿಯಡಿಗಿಂತ ಮುಂಚೆನೇ ಏನು ಮಾಡ್ತಾರೆ, ಕಾಂಟ್ರಾಕ್ಟನ್ನು ಎಂಡ್ ಮಾಡಬೇಕು. ಆ ಥರ ಕಾಂಟ್ರಾಕ್ಟನ್ನ ಎಂಡ್ ಮಾಡಬೇಕು ಅಂತ ಏನಕ್ಕೆ ಬರುತ್ತೆ, ಒಂದು ರೀಸನ್ ಏನಂತ ಹೇಳಿದ್ರೆ ಅಲ್ಲಿ ಮ್ಯೂಚುವಲ್ ಅಂಡರ್ಸ್ಟ್ಯಾಂಡಿಂಗ್ ಇರಲ್ಲ ಒಂದು. ಆಮೇಲೆ ಇನ್ನೊಂದು ಏನಂತ ಹೇಳಿದ್ರೆ ಪ್ರೈಸಸ್ ಫಾಲ್ ಆಗ್ತಾ ಇರುತ್ತೆ. ಆ ಕಾರಣಕ್ಕೋಸ್ಕರ ಏನು ಮಾಡ್ತೀವಿ, ನಾವು ಡೈಲಿ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಮಾಡೋದು ಬೇಡ ಅಂತ ಹೇಳಿ ವಿ ವಿಲ್ ಬಿ ಗೋಯಿಂಗ್ ಟು ಎಂಡ್ ವಿ ವಾಂಟ್ ಟು ಎಂಡ್ ಅಪ್ ವಿತ್ ಅ ಕಾಂಟ್ರಾಕ್ಟ್, ರೈಟ್? ಆ ಥರ ನಾವೇನಾದರೂ ಕಾಂಟ್ರಾಕ್ಟನ್ನ ಎಂಡ್ ಮಾಡಬೇಕು ಅನ್ನೋ ಒಂದು ಥಾಟ್ ಅಥವಾ ಯೋಚನೆ ಬಂತು ಅಂತ ಹೇಳಿದ್ರೆ ಆ ಥರದ್ದನ್ನು ನಾವೇನಂತ ಕರಿತೀವಿ, ಬಾಟಮ್ ಲೈನ್ ರಿಸ್ಕ್ ಅಂತ ಹೇಳಿ ಕರಿತೀವಿ. ಓಕೆ, ಬಾಟಮ್ ಲೈನ್ ಅಂತ ಹೇಳಿದ್ರೆ ನಥಿಂಗ್ ಬಟ್ there are like flatter situation. Okay, they don't want to continue or they don't want to end as well. Okay, ಅದನ್ನು ನಾವು ಯಾವ ಥರ ಮೀನ್ಸ್ ಕಾಂಬ್ಯಾಟ್ ಮಾಡ್ಬೋದು ಅಂತ ಹೇಳಿದರೆ ಅಥವಾ ಕಾಂಪೆನ್ಸೇಟ್ ಮಾಡ್ಬೋದು ಅಂತ ಹೇಳಿದರೆ ಥ್ರೂ ದ ಪ್ರಾಪರ್ ಮ್ಯೂಚುವಲ್ ಅಂಡರ್ಸ್ಟ್ಯಾಂಡಿಂಗ್. ಓಕೆ, ದಟ್ ಈಸ್ ದ ಬೆಸ್ಟ್ ವೇ to mitigate this bottom line risk. Okay, so guys, I'll stop this video till this 8 types of risks, and in further video I'll do the another 8 type of risks. Okay, if you have any doubts, please put in a comment box. Okay, thank you.